Welcome to the Sharon Partners Quarterly Market Update. I'm Billy Oswell and joined by Steve Garth, the newest member of the Sharon Partners Investment Committee and our external consultant. Good to have you here, Steve.
Yeah, thank you, Billy. It's good to be here. And hello, everyone watching.
It's 2020, it's fair to say, has been a pretty wild ride all round, and financial markets certainly haven't been immune to what we've seen. We know there was a steep drop-off in equity markets in the first quarter. We've just finished the second quarter, which was also the end of the financial year. What can you tell us about what's happened?
Well, it's absolutely been a wild ride in financial markets, Billy. And as you correctly said, the first quarter, which was just terrible, the second quarter, in many ways, has been the best quarter we've seen for decades. And of course, that's due to the government stimulus and the low interest rates. So I'm going to put a chart up in a moment that shows us how the Australian market went. And then we'll also talk about how the US market has gone. So you can see in this first chart we're showing where we've highlighted the last quarter in that grey area. And you can see the Australian market ticking along until, of course, early February, where news of the coronavirus came out, and the market then fell by a whopping 23%. And that's the return you saw in the first quarter. But you can see the recovery where the market's now up by 17% in the second quarter. Now, I haven't got a chart here of the US market, but that's even more impressive. The US market fell by around 20%, and guess what? It recovered, went all the way up in the second quarter, returns about 20% in the second quarter. So it's completely wiped out what happened in the first quarter. And in fact, quite remarkably, the US market is up by about 8% over the whole 12-month period. That's extraordinary given what's happened.
Well, it's certainly comforting to hear after the first quarter of the year. And can you take us a little bit deeper in terms of what's contributed to that better performance that we've seen in the last 3 months?
Yeah, Billy, look, let's go through how the different asset classes have gone, starting with cash and to bonds, equities we just talked about, but also real estate and also the emerging markets. So I'm going to put up a chart now which looks at the quarterly performance of each of those asset classes. So in this chart, starting at the left-hand side, we're showing Australian cash, and you can't see that because it's pretty close to zero. It's a 0.06% return for the quarter. That corresponds to about 0.25%, which of course is the official cash rate. Next to that, we've got Australian bonds, which had a negative 1.3% return for the quarter only. Now, that might surprise some people that the bonds have got a negative return, but bonds do have some volatility. They do go up and down, just not as much as equities. If you look at the global bonds, that's the next column, that had a return of 2.3%, so not bad compared to a cash rate of 0.25%. And that tells us something about the advantage of having global bonds rather than just Australian bonds. Over the whole year, both the Aussie bond portfolio and a global bond portfolio returned around 5%. Again, that's a pretty good return over the year given what's been going on. The next bar you see there going up is the Australian equity. We talked about that up by about 17%. And next to that, what looks to be the best asset class is Australian listed real estate, what they call REITs. That's up by 20% in the quarter, but that of course had the worst quarter. It was the worst performing asset class last quarter. So that's just coming off a very low base. Next to that, we've got developed markets for the unhedged investor returning around 5%, and for the hedged investor, returns of around 20%. And Sharon Partners clients are in typically a 50-50 hedging, so you get half of each of those. The next bar there going just down a little bit, that's global real estate. So quite different to Australian real estate, which has got that strong positive uptick. The global real estate is slightly negative, but that's because it actually didn't fall that much in the first quarter. And that's probably got a little bit to do with the fact that Australia was very quick to lock down offices and have the lockdown start quickly. So that affected the market price of real estate or commercial real estate very quickly, where in other markets that's really just been happening. So that's why you see the slight negative return there. And for emerging markets, they've got a positive return of around 5%. That's much the same as the return on developed markets.
Steve, as you well know, the part of the Sharon Partners philosophy includes a tilt towards smaller companies and value-style companies, which we believe will add value over the long term. How's that looked in the last quarter?
Yeah, well, in Australia, there's been a big small cap premium and a big value cap premium in the quarter. And even over the year, small caps have done better than large caps in Australia. Over the year, value stocks haven't done as well at this point. When we turn to the global markets, we'll see again that same small cap premium, but in this case, value stocks have underperformed the broader market. And Billy, when you look at the underperformance of value, it really comes down to this set of stocks in the US, what they call the FANGs: Facebook, Apple, Amazon, Google, Netflix. And they've had an incredibly strong performance for the last couple of years. They're all large growth companies, and of course, even in the pandemic, everyone's watching more Netflix, and so again, they've had a strong return. So that is affecting that value premium in the longer run globally.
And I suppose carrying on from that, if we compare the performance of the Australian market to, say, the US market, is that as well influenced by the performance of those big FANG stocks?
Look, absolutely, Billy. We mentioned earlier that the Australian market is down 7.8% over the last 12 months. The US stock market, to a US investor, it's up like nearly 8%. It's just extraordinary. With the period we've been in over the last 12 months, the market's up by 8%, and it's all due to these stocks. They're just absolutely dominating. They take up about 25% of market cap of the overall US stock market, so these 5 companies are massive weight, and they've really had this phenomenal run. Will it continue? That we don't know, but we do know that typically these companies that have great runs, it doesn't last forever.
And I know you haven't made a definite prediction there on the direction of the FANGs, but if I can try and coax you into one more broadly, what should we expect looking forward?
Well, when we look at the economy, it's not great. The outlook for the economy is definitely very uncertain. And I really can't imagine that the economy starts recovering until people start going about their day-to-day business in a normal way. But I think it's really important to remind our viewers that the economy and the stock market are 2 different things. So while the outlook for the economy is not great, it's very uncertain. That doesn't tell us anything about how the stock market will behave. And there's not a greater example of that than what we've just been talking about in this quarter, Billy. Phenomenal returns, returns that we haven't seen for decades, in a period where the economy is going so bad. There's so much government support out there. So when you hear the bad news about the economy, don't tie that back into what the stock market will do. The stock market, people are looking at the stock market and pricing in expectations that are 5, 10 years down the future, where the economy looks at what's happening right now.
Brilliant. Thanks, Steve. Appreciate your insights, and that wraps up our quarterly update for this period. We look forward to getting your thoughts again in a few months' time, and of course, as always, if you have any further questions or want to reach out, please don't hesitate to contact your advisor, and they'll be happy to help.
Yeah, terrific. Thank you, Billy, and we look forward to seeing everyone again in a couple of months.